The Psychology of Money by Morgan Housel is a fascinating exploration of how our attitudes and behaviors towards money are shaped by a complex array of social, cultural, and psychological factors. Through a series of captivating stories and insightful analyses, Housel reveals how the pursuit of wealth, financial decision-making, and our relationships with money are all deeply influenced by our own experiences, biases, and beliefs. One of the central themes of the book is the importance of developing a healthy relationship with money that goes beyond mere accumulation. Housel argues that our obsession with acquiring more wealth is often driven by deeply ingrained societal expectations, which can lead us to make poor financial decisions that undermine our long-term well-being. He offers a compelling case for why we should focus on building financial resilience rather than chasing ever-increasing levels of wealth. Another important concept that the book explores is the role of narrative in shaping our attitudes towards money. Housel argues that the stories we tell ourselves about money and wealth are a powerful force that can either empower or limit our ability to build a secure financial future. By examining some of the most powerful narratives that influence our relationship with money, he shows us how we can reframe our own stories to create more positive financial outcomes. Overall, The Psychology of Money is a rich and thought-provoking exploration of the complex interplay between money, psychology, and human behavior. Housel's insights are both practical and profound, offering a powerful toolkit for anyone looking to build a healthier, more sustainable relationship with their finances. Whether you're a seasoned investor, a financial planner, or simply someone looking to improve your financial literacy, this book is a must-read. Here are the top 3 favorite lessons from the book. Being greedy can turn out to be the biggest financial mistake you'll ever make. Envy has no place in the money market, as it can blur your thinking. Our early experiences with money determine our financial decisions later on. Now, let's discuss these lessons in detail, and see how we can benefit from them. Lesson 1. When it comes to managing your money, it's better to leave greed out of it. Are you a greedy person? Of course not. Or at least, that's what you tell yourself. We all like to think highly of ourselves and blame our misfortune on bad odds. This is the case of Jesse Livermore, a stock market trader born in 1877. Prior to the notorious market crash that occurred in 1929, he took a short position, betting on the decline of the market. He made over $100 million, the equivalent of $1.6 billion today. Instead of enjoying his riches for life, however, the winning trade made Livermore feel invincible. Naturally, it wasn't long until he lost everything he had earned by placing all the wrong trades. The sudden downfall pushed him to the edge, and he eventually, sadly, ended his life one night. The problem was that his success made him want even a bigger slice of the cake, although he already had more than anyone could wish for. The lesson here is, don't be greedy, and learn to be humble. When you already have what you wished for or accomplished significant goals in your life, learn to be grateful, maintain your status, and enjoy the present, instead of always seeking more and more. When you're scared of losing everything you have, you won't be happy to risk it all for potential gains. Lesson 2. Strong emotions such as envy can push you towards making sloppy decisions. Most people know that investing takes time. They even want to stick to their investments through good and bad, but then the fear of missing out or envy get in the way, sometimes both at the same time. Managing your emotions is one of the most important things you can work on if you want to become financially independent. Always remember that your journey will be different from any other person you know, so there's no need to compare yourself to them or be jealous of anyone's greater assets. Just take the example of Rajat Gupta, the former CEO of McKinsey. Although he came from a modest background and made it to $100 million in net worth, he still was envious of Warren Buffett for being a billionaire. As such, he committed insider trading, which is one of the most common yet dangerous financial crimes for investors, and got charged with a substantial prison sentence for it. In other words, he let envy get the best out of him and paid for it 1,000-fold. Was it worth it? Definitely not. However, His misfortune serves as a valuable lesson for anyone looking to make better financial decisions. Be rational and think twice when it comes to money. Always filter out your emotions. Lesson 3. The experiences we have early on in our life determine our financial decisions. We all grow up differently. Was your childhood similar to someone born in 1800? 1900? Of course not. Some people grow up in times of financial crisis. Others know nothing but bull markets until they are in their 30s. As such, those two types would have very different opinions about what a good investment strategy consists of, whether a portfolio should be stock-based or bond-based, or how much risk is worth taking. We may think that we have no hidden biases, but a study conducted by Ulrika Malmendier and Stefan Nagel proves that people invest according to how the economy looked like when they were young adults. As such, someone who's experienced high inflation may not see bonds as a good investment, while someone who's been through turbulent times may think the opposite. It is of utmost importance that we acknowledge our hidden biases, so as to be able to diminish them and make better choices. In general, any financial decision should always be backed up by sound analysis, reliable facts, and a mind open to new perspectives and constructive criticism. Moreover, you should work on your ability to adapt to trends and destroy your phobia of new ones, even if it contradicts your inner beliefs. The money market leaves no room for subjectivity, biases, or impulsive decisions. Rushed investments can wipe off years of savings, while valuable ones can speed up your journey to financial freedom. The Psychology of Money Review. If you feel like you've made all the wrong financial decisions, or that wealth is just not one of the things you'll ever be able to achieve, The Psychology of Money is the book for you. Reading it will open your mind towards new perspectives and have you conduct an introspection to realize how biased you were all along. This book will give you little steps to take to see instant changes in your financial life. Thanks you for watching this video.